I did my best to research and compare what I consider to currently be the best ETFs for European investors. After all, picking the right ETF to invest in can be very overwhelming, especially at the beginning of your investing journey. My wife and I were in the same situation 8 years ago. And when looking back today, we're very grateful we didn't let that stop us from getting started. No matter if you're looking to buy an S&P 500, MSCI World, FTSE All World, small cap ETF, or you're following a different strategy, I'm confident you're going to learn something useful from this video. By the way, I decided to only focus on physically replicating ETFs which directly hold the stocks of the index they're tracking, and not synthetic ones, which replicate the index performance through swap contracts, as those come with additional counterparty risk. I'll also only mention accumulating ETFs, which automatically reinvest dividends from the stocks they hold into more shares of the stocks in the index. That's because accumulating ETFs are more tax efficient in most European countries, and I don't want to make this video even longer than it needs to be. You're of course free to do things differently, and you'll easily be able to find their distributing counterparts using my favorite research tools for ETF investors. Chances are you may have learned about investing on an American YouTube channel or blog, only to then be disappointed that you can't buy that same US-based ETF as a European resident due to regulations. Luckily, in most cases, you simply need to find a version that's domiciled in Europe using websites like justetf.com. You can then find it using your European broker of choice, either via its ISIN number or its stock exchange ticker at the bottom of the page. Speaking of that, you can find my favorite low-cost brokers in Europe for ETFs linked down below, which is a great way to support me if you'd like to. Just ETF can also be useful to compare the performance of different ETFs as long as you keep one thing in mind. When making comparisons, set the date back at least 1 week instead of picking the current day to get more accurate data. I also like to use FondsWeb as a second source, which is sadly only available in German when comparing ETF returns. TrackingDifferences.com is another useful resource to check how closely ETFs have been tracking their index over time. In this case, a negative value means the ETF outperformed its underlying index. World ETFs outperforming their index is something that's completely normal, by the way, because ETFs domiciled in Ireland pay a lower 15% withholding tax on US dividends internally, while the index comparison always assumes a worst case withholding tax of 30%. ETFs can also generate additional returns by lending out some of the stocks they hold against collateral, something I looked at in detail in another video you can watch afterwards. To get the most current and most accurate index tracking data possible, you can look up each ETF on fund issuers' websites directly, for example Vanguard, iShares or Spider. That's exactly what I did for today's video, since I wanted to provide you with information that's as up to date as possible. And the last resource I need to mention is Backtest by Curvo. Here you can create a portfolio and see how it performed over a specific period. For example, here you can see that a theoretical 10,000 euro investment in the MSCI World Index in December 1978 would have turned into almost 1 million euros by December 2024, or that a recurring investment of 1,000 euros every month since then would have turned into over 8 million euros. Of course, we're only looking at the past here, and there's no guarantee the same is going to happen in the future. Even still, it shows you how investments can compound over long time periods. And in my opinion, looking at long-term charts like this also helps you zoom out and put things into perspective when markets are down and it feels like the world is about to end once again. Alright, it's finally time to look at what I consider to be the best ETFs right now for European investors. We'll go over each index and the best ETFs for it, starting with the most popular one, which accumulated the most funds in Europe so far. Which means we need to start with the S&P 500 index, covering the 500 largest publicly listed companies in the US. And I get it, if you're going to bet on stocks from a single country based on over 100 years of stock market data, it might as well be the US. I personally still prefer investing globally via all world ETFs, as I don't like the idea of putting all my eggs in a single basket, in this case only stocks based in the United States. But I'm certainly not here to judge anyone that picks this route for whatever reason. In fact, here's a recent video of mine you can watch afterwards, which may help you with your own decision. After lowering its fees to only 0.03% per year, the Spider S&P 500 is a current champion as far as internal costs go. At plus 0.22% compared to its index, it also had the best tracking difference in 2024, compared to plus 0.19% for the iShares Core S&P 500 and plus 0.18% for the Vanguard S&P 500. That's not to say that either of the two alternatives I just mentioned are bad by any means, as the difference is minimal. I'm simply mentioning the one I would pick as a European investor if I was looking for an S&P 500 ETF today. Now, what if you change your mind and you decide that you want to add international stocks from developed countries outside the US later on? Or maybe you simply want to have full control over how much you allocate to the US and stocks based in other countries. After all, US stocks now make up more than 70% of the MSCI World based on their market cap. That's where some new ETFs covering the MSCI World ex-USA index come in, with this one by Xtrackers being the one I would currently pick based on its size and fees. All of a sudden, the decision of how much you allocate to US stocks and the rest of the world is completely up to you. I could imagine something like this, for example. 60% US stocks using the SPDR S&P 500 ETF and 40% other developed country stocks using the Xtrackers MSCI World ex-USA ETF. With a combined total expense ratio of only 0.078%, you even manage to reduce your yearly holding fees compared to the least expensive MSCI World ETFs out there, which start at 0.1% per year. Next, we have the popular MSCI World and other indices covering developed markets. First, the best known of the bunch, the MSCI World, containing a total of 1,395 stocks. The very similar Solactive GBS Developed Markets Large and Mid Cap with 1,431 stocks, and the FTSE Developed Index containing as many as 2,016 stocks. While the first two are quite similar in what they cover, the FTSE Developed is a bit broader, as it also includes stocks from South Korea and Poland, as well as some stocks with a smaller market capitalization. As a result, if I was looking for a single ETF to cover developed markets, I would have a slight personal preference for the FTSE Developed World by Vanguard, which luckily also had an excellent index tracking difference over the past 5 years. That's not to say that an MSCI World ETF is a bad choice by any means. In fact, the difference between the two indices is likely going to be minimal over long time periods. And if I was looking for an MSCI World ETF myself, I would currently pick the one by SPDR with a total expense ratio of 0.12% and an outstanding tracking difference over the past few years. Meanwhile, you only have a single option covering the relatively new Solactive GBS Developed Markets Index, the Amundi Prime Global, with an impressively low total expense ratio of only 0.05% per year. The ETF moved its domicile to Ireland after being based in Luxembourg for the past few years, which should now make it more competitive to other world ETFs, since the Luxembourg domicile resulted in higher withholding taxes on US dividends. Having said that, we still need more data on its index tracking difference after having been relaunched, so I would wait a year or two to see how it does, also in comparison to MSCI World ETFs, which it's trying to compete against. One more thing you should know is that the French asset management company Amundi is actually applying sort of a light ESG filter to its Prime Global ETF, something they should more clearly disclose on their website in my opinion. This means they're not simply passively replicating the underlying index as is the case with SPDR, iShares or Vanguard, but actually excluding companies from sectors they don't like. One such exclusion is Lockheed Martin, the 117th largest stock in developed markets, as you can see here in SPDR's MSCI World, which is part of Amundi's underlying index but completely missing from its ETF. I didn't have time to check what other stocks from its index were excluded on purpose, and I also understand investors that don't mind the exclusion of certain kinds of companies, but it still means the ETF is deviating from a simple passive index investing approach. And who's to say they're not going to tighten these rules further in the future, excluding additional companies simply because they don't agree with how the French asset management company sees the world. Sadly, Amundi has not built the best reputation lately due to how often they've merged funds, moved their domicile, which can be a tax nightmare in some countries, or how they've changed funds to suddenly track an ESG version of the index later on, sometimes even increasing its fees like in this example. Hopefully they stop doing this in the coming years, but all of this is why I personally feel better with funds issued by American asset management companies like Vanguard, Invesco, SPDR or BlackRock aka iShares. Now let's look at ETFs that are actually investing globally, covering both developed and emerging markets. Here we have the MSCI All Country World Index with 2,647 stocks, the MSCI All Country World Investable Market Index with 8,640 stocks, the FTSE All World covering 4,247 companies, and the Solactive GBS Global Markets with 3,435 stocks as it stands. A single global ETF is my preferred way to invest long term, as it enables me to not only cover stocks from developed markets, but also from promising emerging markets like India via a single fund. I never want to ask myself in a decade or more if I made the right decision by excluding specific regions, as it's impossible to know beforehand which country's stocks are going to perform best in the future. That's why my wife and I invested most of our monthly savings into FTSE All World ETFs over the past 8 years. But that's just my personal preference. You have to decide for yourself which strategy you're the most likely to stick to for the long term. And these are what I believe to currently be the best ETFs for this strategy depending on the index you pick. The iShares MSCI All Country World comes with a total expense ratio of 0.2% per year and a solid tracking difference since 2021. In fact, it outperformed its underlying index for 3 out of the last 4 years. I'm not looking at its tracking difference before 2021 on purpose, since that was its first full year with a reduced yearly fee of 0.2%. The Spider MSCI All Country World could be an even better option to cover this index, ever since it reduced its total expense ratio from 0.4 to 0.12% per year last August. Looking at its tracking difference during the last few years when its fees were still 0.28% higher, I wouldn't be surprised to see it outperforming the iShares ETF going forward, at least until iShares doesn't lower its TER further as well. If you want to go even broader, the Spider MSCI All Country World Investable Market ETF is a great option with an expense ratio of 0.17%, which even includes small cap stocks based on their market cap in the underlying index. Its tracking difference could be better and more predictable though. Just looking at the past 5 years, we've seen everything from a 0.9% index underperformance in 2020 to 0.88% outperformance in 2022. Hopefully that's going to improve as it grows the number of stocks it holds compared to the underlying index. Honestly, I would be just fine holding either of the 3 ETFs I just mentioned long term, but I still have a personal preference for the FTSE All World. For the longest time, the Vanguard FTSE All World was the only one my wife and I were buying on a monthly basis, and it's still an excellent pick with a solid tracking difference that's very close to the index. That being said, due to Vanguard's reluctance to finally lower its now comparatively high fee of 0.22% per year, my wife and I started buying the Invesco FTSE All World with a 31% lower total expense ratio of 0.15% in July instead. Just to clarify, we're still holding on to our existing Vanguard shares, which are nicely in profit, for tax reasons until we actually need the money, for example in retirement. Invesco's tracking difference has also been excellent so far, beating the index by 0.4% in 2024 and 0.42% so far since its launch in mid-2023. Last but not least, we have the new Amundi Prime All Country World with its impressively low fee of 0.07% per year, covering the Solactive GBS Global Markets Index. The ETF launched less than 11 months ago in its distributing version, which has grown quickly in size, but the accumulating version, which came out 4 months later, is still sitting at an AUM of less than 100 million euros, which means it likely comes with much higher spreads when buying and selling due to lower liquidity. We still need to wait and see how closely these Amundi ETFs track their underlying index as well, since they're still so young and haven't made it through a full calendar year yet. Sadly, Amundi is once again excluding specific companies from sectors it doesn't like here as well. Something I already mentioned with the Amundi Prime Global in the previous section of this video. That, in addition to how often the French fund provider burned ETF investors in the past via ESG conversions and fund mergers, is why I personally didn't even consider this one when I was looking for a new ETF for my one ETF strategy and went with Invesco instead. But you're of course free to do things differently. This is simply my personal opinion. I was also happy to see that the Invesco FTSE All World managed to slightly beat its performance so far, which goes to show you that fees aren't the only thing we should be focusing on. Having said that, this could of course change anytime, so it will be interesting to compare these ETFs long term. Now, what if you want to add or increase your exposure to stocks from emerging markets? For example, you could add 10% emerging markets to a world ETF to get closer to an all country world or FTSE All World ETF yourself based on current market caps. In order to avoid stocks overlapping between ETFs, I would currently pick the iShares Core MSCI Emerging Markets Investable Market ETF if you're mixing it with the MSCI World, and the Vanguard FTSE Emerging Markets if you want to add it to a FTSE Developed World ETF. Next, we should also cover smaller companies, better known as small cap stocks. These generally carry more risk and are more volatile, but they have historically outperformed large and mid cap stocks over long time horizons. That being said, there's obviously no guarantee that's going to be the case going forward as well, and they can also underperform over a decade or more. In fact, they slightly underperformed on average the past 20 years. One option to have exposure to small cap stocks is by simply picking the Spider MSCI All Country World Investable Market ETF I already mentioned as a one ETF solution, which already includes small cap stocks according to their market cap in the index, which, in case you're wondering, is currently hovering around 10%. And option number 2 is adding a small cap ETF, for example with an allocation of 10 to 15% to a world ETF like the MSCI World, FTSE All World or MSCI All Country World. Here my first pick would be the iShares MSCI World Small Cap, containing a total of over 3,300 small stocks with an impressive tracking difference over the past 4 years. The newly launched Avanti's Global Small Cap Value ETF could also be an interesting option to look at. Just keep in mind it only launched in September, so it's still very new and has a relatively small fund size of $140 million for now. It will be interesting to see if it manages to outperform the iShares MSCI World Small Cap over a long time horizon with its more active approach and greater weighting on companies with low valuations and high profitability. Last but not least, what if you want to increase your allocation to European stocks? Perhaps you believe that European companies deserve a higher weighting than the 13.7% they currently make up in all world ETFs or the 14.9% in the MSCI World right now. As a result, you could increase your exposure by adding an ETF specifically for Europe, for example with a 10% allocation. These two ETFs could be a great option to achieve that. The Vanguard FTSE Developed Europe, which comes with an impressive index tracking difference, or if you're specifically targeting smaller companies, the X-Tracker's MSCI Europe Small Cap, which also had an excellent tracking difference the past 4 years. When it comes down to it, in my opinion, investing doesn't have to be complicated. As long as you have a long enough time horizon of at least 5 years, ideally 10 years or more, when investing into ETFs, and you're able to stomach negative years as well, in my opinion, a single global ETF could be enough for most people long term. My wife and I also started with a very complex ETF portfolio back in 2017, which we've since then simplified to us only buying a single ETF on a monthly basis, the accumulating Invesco FTSE All World. You can see our entire journey, including all of our mistakes, in this video if you haven't seen it yet. It's of course fully up to you how you invest, how many ETFs you hold, whether you add bonds, real estate or other asset classes, and how aggressive or conservative you are in your allocation. By the way, it's perfectly fine if you prefer distributing ETFs, meaning ETFs that pay out dividends to your brokerage account in cash, instead of accumulating ones which reinvest these into the fund, raising its share price by that amount. You can find distributing counterparts to most of the ETFs I mentioned using just ETF. I'm also going to add all the ETF names and ticker symbols in the description below, as well as links to my favorite low-cost brokers in Europe to buy them, which is a great way to support me if you'd like to. And don't forget to gently tap the like button and to subscribe while you're there if you haven't yet. Now, you may still feel that it's unfair that we can't buy US domiciled ETFs in Europe due to regulations. While I get that, you may be surprised to hear that these could anyway be a very bad idea due to US estate taxes, which can be as high as 40% of the total amount. I talk about this extremely important topic in this video right here, which even applies to individual US stocks many people hold. So make sure you check it out if you haven't seen it yet. As usual, none of what I mentioned today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching. Have a wonderful day, and until next time.